Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Welcome everybody to another Small Cap Discoveries conference call. Today on the call we have Mike Robb of AirIQ. AirIQ trades on the venture exchange under the symbol IQ. Currently has roughly 29 million shares outstanding. Looks like it closed today at around 51 cents for about roughly a $15 million market cap. It is November 20th, 2025. Hi Mike, how you doing?
I'm great, Paul. Thank you.
Perfect. Good to have you back. It's been a long time since we last spoke, at least in this format. So happy to have you here. Since it's been so long, we'll jump into it. We'll give you an opportunity to present, and then we'll follow up with some questions.
Great. Thank you, Paul. Excited to be here, and thank you for having me again. It has been quite some time. Um, Let me start with some boring disclaimer information. I'm sure everyone is familiar with this. I won't delve into this too deeply. The audience can read this at their leisure at a later date. Um, you know, Maybe as you know, or your audience knows, the AirIQ has been around for almost 30 years in the fleet and asset management space. The key to our longevity has been our ability to evolve over time. We are never standing still. We are never satisfied with where we are or where we've been. The AirIQ team works tirelessly to deliver growth and best-in-class solutions and care to our customers and creating value for our shareholders. Um, we are now in a new evolutionary phase of our journey, and one that I'm very excited to discuss with you today. I will quickly walk through some of the highlights of our annual and current financial metrics and move more to a thorough discussion of our growth strategy, and we'll close by answering any questions. During the last fiscal year, it marked our 8th consecutive year of recurring revenue growth, where we reached $4.8 million in those revenue streams, up 10% over the prior year. In addition, we delivered our 10th consecutive year of positive operating profits. During the first half of our current fiscal year, recurring revenue growth remained strong as we set new records resulting from organic growth driven by new customer wins and through our new partnerships. With the addition of our recently announced asset acquisition, we have now surpassed the annual recurring revenue run rate of $6 million. We remain debt-free, and we have approximately $13 million in tax losses that would be attractive to an acquirer of AirIQ. Moving on to our market cap, Paul, you've already summarized that very succinctly. We closed yesterday at 52. We closed today at 51, I believe. Market cap of around $15 million with 29 million shares outstanding. I will remind everyone that 29 million shares is after returning almost 1 million shares over the last 12 months back to Treasury. Those shares were repurchased under our NCIB program at an average price of about 35 cents. This has been a terrific return on capital and value creation for shareholders to date. With $2.6 million in cash in the bank and an unused operating line of credit of $750,000, we are well positioned to act on growth opportunities as we continue to scale. AirIQ has been able to deliver consistent annual increases in book value per share. Since 2014, we have achieved a 23-fold increase in the book value per share, which represents a compound annual growth rate of about 33%, which proves our ability to generate value for shareholders over a long period of time. I have a high degree of confidence in our ability to continue to deliver returns in the future, and our numbers will reflect that as well. In the past 8 years, recurring revenues have grown 145% in total, reaching $4.8 million, with double-digit increases over the prior year. While we're proud of what we've achieved to date, we have not been particularly satisfied with the rate of growth of those recurring revenue streams. To be honest, it's been disappointing. As a result, we decided to make a decision to invest heavily in sales and marketing to drive future recurring revenue growth. We have expanded our growth partnerships, our product and service offerings, and we've just successfully closed an acquisition and are in the early stages of establishing a new go-to-market channel. I will discuss each of these areas throughout the remainder of the presentation. As a result of these investments, we are now seeing unprecedented recurring revenue growth that has now surpassed $6 million in ARR that we are driving to increase in future quarters. As mentioned, we are in a new evolutionary phase of AirIQ. The key to this current phase of our evolution has been working alongside new trusted partners. Earlier this year, we partnered with Global Emission Systems, Inc., or GESI. This is a marketing partnership with a focus on the NHRA, or National Hot Rod Association. You may have noticed that the AirIQ logo appeared on a couple of race cars through our social media posts during this current calendar year. This partnership not only increases our brand awareness, it provides AirIQ with access and engagement one-on-one with some of the biggest names in the transportation vertical at each of the NHRA races held through the US each year. Last year, AirIQ signed a master reseller agreement with Phillips Connect. We are now only one of 2 master resellers in North America. The partnership has provided AirIQ with greater access to the transportation market segment. We are now able to compete in this very large and growing market with our partner at Phillips Connect. The partnership with Phillips Connect and working with them to deliver commercial transportation solutions was instrumental in AirIQ winning a new customer with annual recurring revenue of $300,000 that we announced earlier in this new fiscal year. This is just the beginning of our journey into this very large and growing market. Our new go-to-market channel that I mentioned earlier is being developed with a new partnership with TD SYNNEX. TD SYNNEX provides AirIQ with immediate access to the coveted American carrier channel that includes T-Mobile, AT&T, and Verizon. This access allows us to leverage each of these carriers' sales forces and their down-channel customers looking for IoT-based products and solutions that AirIQ can provide. The combination of access to the largest transportation customers through our partnership with GESI, Phillips Connect trailer solution offerings, and carrier data partners with TD SYNNEX has created a growing opportunity channel that has not existed previously. We are very excited about this journey and the potential impact that these new partnerships are expected to have on recurring revenue growth in the future. Our key strategic partnerships allow AirIQ to enable seamless integration and collaboration with our partners. By utilizing our partners' hardware, software, and cellular airtime connectivity, we are able to provide problem-solving solutions to our customers in the sometimes fragmented world of IoT. This has allowed the company to expand its products, solution platforms, and data plans well beyond our offerings in the past. This allows us to be successful in penetrating deeper and further into growth markets that we never could before. Again, I'm extremely excited by what I see in our opportunity pipeline that is being driven by our expanded partnerships and new product offerings. This new phase of our evolution is driving us up higher in the food chain towards larger and higher value customers that attract higher recurring revenue potential. Our growth strategy is primarily focused on delivering solutions to the very large construction and transportation markets in North America. AirIQ is able to attract, win, and retain customers in these markets thanks in large part to our new and existing partnerships and our ability to bring new products and solutions to meet the ever-changing needs of our customers. The construction market has seen a recent explosion of investment in Canada as the country invests in new infrastructure. Similar investments are being made south of the border too. AirIQ has a robust product offering that allows customers to track and manage their assets in near real time. The construction market requires many of the products and solutions that we offer, including our AI-enabled dashcam, tool tags, and other tracking and maintenance solutions. The transportation market is a relatively new one for AirIQ. Our partnership with Philips and Jesse are driving significant new and high-value pipeline opportunities. Philips Connect offers solutions for everything trailer-related, or as we like to call it, the Internet of Trailers, IoT. Existing products, such as the AI-enabled dash camera, that now includes an extended camera offering following our recent acquisition, tracking and the mandated electronic logging device, or ELD solutions, increase AirIQ's value proposition by bringing these technologies together to provide best-in-class cab-to-trailer solutions. During the past year, we made the strategic decision to have our sales team focus on our offering of our rental program to our customers rather than our hardware purchase and service plans. I've received many comments and questions about this strategy in the past. I will now explain the rationale for that decision while keeping in mind our goal is to increase recurring revenue streams that drive shareholder value creation. Stepping back, every solution that AirIQ offers requires a piece of hardware, a data plan through a SIM card that collects data on the device and transmits that data through the cellular networks to a back-end platform solution that shows the customer their ROI, their return on investment, what they're looking for, how to track their assets in near real time. The margins on the sale of a piece of hardware when we sell just the hardware with a monthly service plan is very, very low. And the resulting subscription plan is also lower as a result of the upfront cost of the hardware to the customer. While this does drive one-time hardware revenue higher, the recurring revenue subscription value is not satisfactory. Now, alternatively, when you take that same piece of hardware and bundle it with a recurring revenue plan under our rental program, the monthly service fee is much higher, driving a higher recurring revenue stream and return over the life of that customer. For example, the average cost to acquire a customer, or CAC, on a rental plan is approximately $2,400. In return, we generate $12,000 of recurring revenue over the life of that customer, or LTV. This is an excellent return on capital with a 5-to-1 LTV to CAC ratio. The rental program delivers higher recurring revenue growth and shareholder value that far exceeds hardware sale and monthly service model. When we compare ourselves to other companies in our space that are publicly listed, we continue to be undervalued. I believe that if we continue to focus our efforts on allocating our capital in the right ways, like we've been doing, my hope is that our valuation metrics will continue to improve. For example, it wasn't that long ago that our enterprise value to recurring revenue multiple was well below two times. This multiple is now over 2 times. This improvement has, I believe, been driven by successfully allocating capital in the most productive ways. Those allocation methods and of our capital have included investments in our rental program that has driven record-setting recurring revenue growth and improved profitability, which I anticipate will continue to improve in future quarters. Recently, capital was allocated for an acquisition that will be accretive to recurring revenue growth and improved profits beginning in Q3 of this year. During the past year, as I mentioned before, we allocated some of that capital to buy back almost 1 million shares of AirIQ at an average price of 35 cents. These capital allocation methods can be used going forward that produce the highest value creation activities and improve our trading multiples. Successfully allocating capital in the right way and at the right time has already had a significant impact to our share price, as it has risen from 35 cents not that long ago to 51 cents today. I have a high degree of confidence and visibility that continued increases in recurring revenue growth and profits will continue in future quarters. I believe that this presents upside opportunity for investors. So why choose AirIQ? In closing, we are a well-managed company with a long track record of delivering recurring revenue growth, profitability, and shareholder value. We have a strong and growing high-quality pipeline for future recurring revenue growth and profits. We have $2.6 million in cash, along with our unused operating line of credit of $750,000 for further acquisitions, investments in our rental program, and for potential share buybacks. We have a clean balance sheet with no debt, and we have $13 million in tax losses that would be attractive to a potential buyer of the company. We are undervalued in the market, providing potential upside investment opportunity. Thank you. That concludes the formal part of my presentation, Paul, and would be happy to answer any questions at this time.
Excellent, Michael. Thank you so much. Yes, as Mike said, if you've got a question, please use the chat function, and we'll ask Michael to answer them. Michael, congratulations, by the way. We've been following the company now for a very long time, I think, and have witnessed certainly the rise in share price along with the rise in fundamentals. At this stage of the business, where are your challenges, or what keeps you up at night running the business?
Yeah, I think, that's a very good question, Paul, by the way. What's been keeping me up at night is, working with the team. So 18 months ago or so, we started to invest in sales and marketing, right? And we brought in some new people, new plans, and my learning experience has, unfolded during this period of time. And, just getting absorbed in this new way of doing things, or different way of doing things, I should say, than what AirIQ has done before, and trying to figure out, how to best leverage those investments to create the shareholder value. And I'm pleased to see, by the way, that the recent quarters that we've laid down are starting to have that impact that I was hoping for. And so, what keeps me up at night now is how do we keep the momentum going? How do we keep what we've laid down and developed over the past year and a half or so? How do we keep this going and growing even better and stronger?
Mhm. Now, Mike, obviously in the last couple quarters here, the word tariff has become pretty commonplace. How are you managing some of the sort of the shifts in the industry and things related to tariffs and in manufacturing of electronic products? I mean, you're probably
Mhm.
hit with tariffs, in a number of ways.
Yeah, and again, Paul, a while ago, if you'd
Mm-hmm.
asked me the question, what kept me awake at night, it would be that.
Mm-hmm.
Um, what we've experienced, as well as everyone else, is the stops and starts, the ebbs and flows. That has been very frustrating, very difficult to navigate at times. But I will tell you that I don't lose as much sleep as I did before regarding tariffs because we have plans. We have a plan A, a B, a C in place that we can pull at a moment's notice if needed, should they get out of hand. We haven't been we have been affected by tariffs, of course. Rising share prices from suppliers, for example, is
Mm-hmm.
the primary, uh, you know, increase in our prices of our products that we bring in. But we haven't really been impacted because of our rental program. It allows us a lot of flexibility
Mm-hmm.
over a longer period of time to, recover that tariff increase. Sometimes we have to increase our pricing to customers, but not significantly. So it hasn't really impacted us. We've seen, we could have been hit with tariffs, bringing products back and forth across the border, that type of thing. We haven't really seen that yet. We have methods in place that reduce that impact for us. And like I said, if that should ever significantly impact us, we have a plan A, a B, and a C. And so we're well prepared for anything that comes our way with regards to tariffs going forward.
Mm-hmm. Um, let's talk a little bit about capital allocation.
Hmm.
You've done so many of the things that I like to tell investors and the CEOs to do.
Hmm.
You really seem to take out a calculator and try to figure out the best use of your capital. Share buyback, you've made an acquisition, you've invested in organic growth. I mean, I think you've covered it all here almost.
Hmm. Hmm.
But going forward, your share price is a little bit higher. You've got salespeople now. Like, how should an investor sort of think, or let's get in your head, how are you going to look to allocate future capital under the sort of current conditions?
Yeah, no, again, Paul, great question. It shifts, right? It shifts depending on where the share price is, right? And
Hmm.
so we were significantly undervalued before.
Hmm.
Now, we're still undervalued, but not as much as before. So at that time, it made sense to allocate some of that capital to buy back shares. Um, the recent acquisition, for example, is something that I looked at very carefully in terms of you know uh, recurring revenue multiples to EBITDA, for example, and where we are now as a company, AirIQ, it's 21x on our
Hmm.
valuation slide there,
Hmm.
but this acquisition was 3x,
Hmm.
right? So my mind shifts from share buybacks to, oh, you know what? If I could buy more accretive acquisitions in that range, then I would like to do more of those, right? I would still like to, and we'll need to, continue investing in our rental program because, again, we have a very strong, growing, high value pipeline that is going to require some of that capital. But that's a great return on investment. Like I said, under that rental program, 5 to 1 LTV to CAC metric, that
Hmm.
is a great return to shareholders on capital. So the way I see it now, share buybacks, if the opportunity presents itself, would be, of course, a lever that we could use and we have used. It's not top of mind right now, to be honest. I
Hmm.
think it lies more in acquisitions, and investing in our growth in recurring revenues and profits
Mhm.
by investing in our rental pools.
Yeah. And, I mean, looking forward, now that you've sort of been a bit more on the M&A front, do you ever see a time where share price matters when it comes to allocating for M&A, for example? Do you anticipate down the road that some point you'd be looking at using shares as a currency?
Um, Again, Paul, you're asking all the great questions. So again, I personally don't like dilution
Mhm.
of our shareholders. Um, so again, I'm not saying never, right? I never
Mhm.
say never, but it's last on my list if we had to. If something came along that required us and it made sense and all those types of things and the right partner came along and all those things and it did provide value to shareholders even though they might get diluted, of course.
Mhm.
But my first instinct is always, can I fund this through operating capital, right? Like what we've
Mhm.
just done with our recent acquisition. And
Mhm.
then can I get that return of capital back over a period of time that is reasonable? Um, so that's my first go-to. My second go-to would maybe be debt if needed.
Mhm.
Um,
Mhm.
Again, not wanting to dilute shareholders. But again, it would have to be a much bigger, significant opportunity that makes sense, that is accretive, and again, we'll remain patient. We'll remain smart.
Mhm.
We're not going to, blow the doors off just to get an acquisition to turn this
Mhm.
thing upside down. That type of thing. Like we've always been. We've always been very
Mhm.
patient and careful. And you know, that's kind of how I look at, maybe issuing shares for a potential
Mhm.
acquisition, Paul.
Mhm.
It's last on the list, but if
Mhm.
needed, we can do it.
Mhm. Mike, so often I talk about management teams that treat their shares like gold, and I think you're a
Mm-hmm.
perfect example. And I can see it in
Mm-hmm.
the other resources that you have access to. You tend to really, value your shares, and I think that's really important for investors. Okay, well, listen, we do have a handful of questions, so why don't we jump on the questions from the audience here?
Perfect.
Let's start with Rahil. Rahil says, could you share some color on rental agreements? What's the average life of a contract, inflation escalators, total life cycle value, etc.?
Yeah, great question. I mean, I don't want to give up too much of our secret sauce on our rental program because I know competitors that we're well aware of are trying to figure out what we're doing. Okay. So I will give you, you know, kind of the highlights, the ranges, that type of thing. Um, you know, the life expectancy of our rental program customer, we've used industry averages of 5 years. We've got customers that just started with us, and we've got customers that have been with us for 15 years.
Mhm.
So we've used an industry average of 5 years to come to that 5 to 1 LTV to CAC ratio in our industry. Um, so, the return on that capital under a rental agreement ranges again anywhere from 6 months to 24 months, right?
Mhm.
The It allows us, like I said, the longer the return period is because if we get into a competitive price situation and it's a significant opportunity that we don't want to lose, we
Mhm.
use our rental plan offering and rates to be competitive in those situations to win the business. That means that our rental return is a bit longer. But where we don't get into those situations, we can charge a premium. We can get that return on capital back faster,
Mhm.
that type of thing. So, that's in a nutshell the mechanics and the economics of our rental program. I think I've answered the question, but if not,
Mhm.
I'm happy to take a follow-up question to that if I haven't.
Sure, sure. So Rahil, yeah, if you'd like any kind of follow-up to that, just let us know a little further down the road. Okay, another question from Rahil. It says, "Are you able to provide any color on DCS's commencement of legal action against AirIQ? When do you anticipate this concluding, and do you have any thoughts on the professional services expenses required to resolve it?"
Wow, great question. I had actually forgotten about that. um, listen, it's there. It's frivolous. It's what we like to refer to internally and from our legal team. It's a nothing burger.
Mhm.
um, they haven't done anything to bring that case forward in any way. We've been more aggressive, trying to push the agenda over this past year, but it hasn't moved. There's nothing happening. It's frivolous. We're defending it,
Mhm.
aggressively, that type of thing. Again, I'm not even thinking about it. It's, there's nothing to it, to be honest. So I don't really spend a lot of time. We're not distracted by it.
Mhm.
Um, if and in terms of costs and everything else going forward, we're just standing still. We're not doing anything. We are not spending our capital. We're not allocating any of that hard-earned capital in
Mhm.
that way, and we don't expect that we will have to.
Okay,
If you
perfect.
look at their financials, they're completely upside down, and
Mhm.
we don't even know if they're going to be uh, around much longer.
Mhm.
But you never know, right?
Yeah.
So that's all we focus on it or don't focus on. We don't focus on them at all,
Mhm.
and we don't expect that we'll need to in the near future.
Mhm. Gotcha. Perfect. Okay, next question comes from Brad. He says, "Could you talk about what might be the perceived reasons for the valuation differences in the helpful comparable slides that you showed?
Hmm.
What might the market be missing?"
Yeah, I think the market has been missing, quite honestly, growth rates, profitability. Yeah, AirIQ's growth rates, like I said at the beginning, I they're great. Like they're okay, for a particular time and spinning off profits and that type of thing, but disappointing, right? So what we're doing now, and I think what we're seeing now is now we're laying down record-setting recurring revenue growth rates over last year. The markets are starting to understand, see that, and we're starting to deliver. To be honest, we're starting to deliver growth with profits. And we're allocating capital in very smart, strategic, accretive ways. And I think the market is starting to realize that. But it's only because we're finally starting to deliver. And I'm finally starting to get back out in the investment community with small cap discoveries, for example, and others, which I haven't done. I've been very busy focusing on the business, building the business, laying the groundwork for this growth, and now we're starting to deliver. So the market, I don't think the market's missed anything. I think the market is now starting to catch up with what we're doing. And because now they can see it, right? They're starting to see it more in
Mhm.
our results. They're starting to maybe see it from our meeting today, how excited I am and how much visibility and confidence I have in what we've done and where I think this is going,
Mhm.
which I have not had before in the
Mhm.
past. So,
Mhm.
I don't think the market's missed anything. I think the market is catching up, and it's going to be a terrific time for AirIQ and its stakeholders.
Fantastic. Okay, next question comes from our friend Jerry Wimmer. Jerry
Hmm.
says, "You recently closed on an acquisition. Has this created a pipeline of new acquisition opportunities?"
Again, Jerry's always asking the right questions.
Hmm.
Um, you know, there's been a couple of acquisitions. We did one last year. It was very small.
Hmm.
Um, that acquisition led to this acquisition. This acquisition has led us to realize that there is a pool of targets similar to the previous two that we've done over the last year. Um, they're of the same kind, same space, that type of thing. We believe that there's more. We've identified more in that particular acquisition pool that we are now taking a harder look at and reaching out to, in addition to all of the other things that we've been looking at over all the years. There's still in play. Um, the gestation period on these things is much longer in some cases, and in
Hmm.
some cases, they're much quicker. This one took some time, but it was under a year. The other one was very quick. Others that I've been working on for 5 or 8 years haven't happened yet. Yet, they
Mhm.
may still happen, but yes, the M&A or the acquisition pipeline has also increased, and that's where I'm going to be spending now that I know the business is running efficiently the way that we'd hoped it would be after making those investments and everything. I now have more time to go and, look at and chase those acquisition opportunities that will be accretive to AirIQ going forward.
Mhm. Fantastic. Okay, Rahil asks, when do you expect AirIQ to reach the Rule of 40 benchmark?
Oh, great metric. Great metric. So I will say that we look, it's not going to be years. It's not going to be a year. I would say, watch and you'll see probably in the next couple of quarters, right?
Mhm.
I'll be happy to
Mhm.
come back on here and say, hey, we reached the rule of 40 metric. We're very close. We are
Right on.
very, very close.
Yeah, yeah, for sure. Awesome. Okay, another question from Jerry. Jerry asks, during the life of the rental agreement, when is the contribution to profit the highest?
The contribution of profit is the highest at the time when the return on capital has been made. So, it's in that 6 to 24 month period. But it is right out of the gate uh, returning high levels of return. What happens is once our capital has been returned to us through the rental program, that allows us to then redeploy that capital into more rental program assets. So, it's in that range of time when it starts to really pick up, but right out of the
Mhm.
gate, it's already very profitable and accretive and everything else. But it does tick up after the capital has been returned on
Mhm.
that investment.
Mhm. And Mike, these units, what's the typical lifespan of some of these units?
Yeah, I mean, these units will last as long as the wireless carrier network is there.
Mm,
So, the 4G network has been in existence for a long time. It
mm,
is expected that it will continue for many more years going forward. There are no 5G devices out there yet. Nobody, there's no need for it.
mhm,
Um, that type of thing. So, again, these devices will survive for a long period of time and are tied to the lifespan of the
mm,
wireless carrier networks through AT&T, Verizon, and T-Mobile networks.
mhm, mhm. Gotcha. Okay, Rahil asks, are you able to share thoughts on customer concentration risk? I think one customer
Mm,
represents more than 10% of total revenue.
yes. So that's always been a concern of ours, right? We don't like having one customer represent that concentration. We're working really hard at ex kind of diluting that customer concentration. I think we're very close to having, you know, other customers come into that uh, dilution factor. And I think you'll start to see that, in the coming quarters where, it won't be just one customer. It will be a few different customers and expanding
Mhm,
upon that. I think that customer concentration will continue to dilute itself as we become more successful in closing those high value pipeline opportunities that I mentioned before.
mhm. Gotcha. Okay, I got a question here. I'm trying to read it and understand it, but I'm going to read it and hopefully you can understand it. Russell says, Mike, would you mind sharing how much higher the lifetime revenue is when absorbing the $2,400 hardware plus higher ARR plus the cost of carrying the hardware versus the previous hardware sale plus lower ARR?
That's an interesting question. Yeah, I'm not sure, Paul, like you, I'm not sure that I
Yeah.
completely understand the question.
So here's what we'll
Um,
do. Russell, if you want to
yeah,
sort of maybe reformulate that question, I'll see if I can ask it and see if we can
sure.
figure it out. But
That'd be
I'm
great.
going to move on to the next one here.
Sure.
Okay, so Rahil asks, fiscal 2022 and 2023 showed year-over-year revenue growth. However, growth flattened in 2024 and 2025. How can I gain confidence that the company will deliver consistent growth going forward and avoid repeating past inconsistencies?
Yeah, I think that, I don't think that it was flat. We've always, as the one chart that I had in my presentation, it has been increasing year over year. Um, Sometimes modestly, sometimes at 8%, sometimes at 13%, sometimes at 10. I
Mhm,
think on average, it's roughly been around 10% over the last, 8 years or so on average. Um, you know, what confidence can I give investors and shareholders as to not repeating those kind of growth metrics in our recurring revenue streams? I mean,
mhm,
all I can say is, look, I have a very high level of confidence and visibility into our next few quarters, several quarters. And I don't see that being the case. In fact, I actually see that our recurring revenue streams, I'm anticipating our recurring revenue streams to be growing at a much faster rate than what I've seen in the first couple of quarters of this year. So, how can I guarantee it? There's no guarantees. Look, we're working
mhm,
hard to make sure that that doesn't happen. That's why we invested in sales and marketing. That's why we're investing more in our rental pool program. That's why those returns and margins and in recurring revenue growth should increase over time. I mean, that's why we're doing and changed. We've changed what we've
mhm,
done in the last 18 months with this investment in sales and marketing and
mhm,
capital allocation in our rental pool program.
mhm. Gotcha. Okay, Russell asks, if a client bows out early in a contract, is there a clause in place to recoup the hardware costs you absorbed upfront?
The simple answer is yes,
Mhm,
and more. There's a
mhm,
penalty clause in each of our contracts that you know, basically says if they do not return the device in good working condition, because it's still our asset,
mhm,
then they are penalized. A penalty that is either at or above the hardware value that we invested.
mhm. Gotcha. Okay, so Russell has tried to reformulate this question. We'll see if
Okay.
it's successful.
Sure.
He says, my previous question, the lifetime revenue of the new sale format versus the old.
Hmm.
Does that help?
Um, yeah, I guess okay. So maybe if I take a stab at it,
Hmm.
Paul, is when we sell a piece of hardware and
Hmm.
a monthly recurring revenue stream, the payback on the hardware is immediate, right?
Right.
It's immediate with a very small margin, one time recur
Hmm.
or, revenue, but the value of the service contract is much lower, as I mentioned, because of the
Hmm.
upfront cost of the share of the to the customer. So
Right.
you know that revenue stream, so the hardware, yes, you get it right away upfront, no time frame for recovery. But what you sacrifice is a higher recurring revenue
Hmm.
at a higher margin, right?
Yeah.
So uh, in the rental plan, yeah, the return of that capital of the hardware is much longer, like I mentioned,
Hmm.
depending on the length of the contract and so on, or the type or the price or anything like that. So that does take a bit more time, but it does come with that higher recurring revenue growth that we're aiming for and
Yeah.
want over a longer period of time.
Yeah.
Hopefully that answers it. I'm not sure.
Yeah, and I would assume that as well. I understand the question now. Like,
Yeah,
most rental programs in the long run are much more valuable than a short run sort of sale and data fee.
right.
And I think as a matter of fact, I think Samsara, that's their big thing is just
Hmm.
that they're able to go out and offer all these home rental programs, but
Hmm.
the recurring revenue is really what they're chasing. So
Yeah,
I think I get it.
that's
Yeah,
right, Paul.
yeah.
And I think the customers like I know I shouldn't say I
Mhm.
know that
Mhm.
rental customers are much more sticky.
Hmm.
to us than if somebody buys the hardware with a lower monthly service plan, because those customers place a lower value on the service because they're paying a smaller monthly fee. They don't
Hmm.
think about once the capital outlay has been made, they don't think about that. They think
Right.
of, oh, it's a small amount. It's like a subscription revenue to
Hmm.
Netflix, right? Like, oh, I don't care about that. It's $8 a month, drop
Hmm.
it.
Hmm.
But if you're paying $50 a month or $40 a month or whatever, there's a much higher value proposition attached to that. It's
Hmm.
a psychological thing, and
Hmm.
the return on that, to the customer, the value add that the customer sees in that is
Hmm.
much the perception of that is much
Hmm.
greater, and the
Yeah.
value of that is much better and
Yeah.
and longer and stickier, to be
Hmm.
honest.
Hmm. That's great. Okay, I'll take two more questions here, and then we'll work to wrap it up here. Jerry
Yeah.
says, "How should we model gross margins going forward?"
Yeah. So gross margins, I think, they've come down a little bit because we give up a little bit of our margin to be competitive, to get the growth rate, that type of thing. I think they've stabilized now
Hmm.
at the levels that we've seen in the second quarter. Again, we do use that at times when needed if we're in a competitive environment where we really don't want to lose that opportunity. We might give up some of that margin, but right now I don't see that we need to, and I think it's
Hmm.
stabilized at the Q2 levels.
Hmm. Gotcha. Okay, last question from Rahil. He says, "Could you please share what competitive advantages your devices have over others, and which new markets are you tapping into, and how's the demand side looking?"
Right. Okay. Yeah. So what we're doing, so the markets that we're concentrating and focusing on right now, like I said, are construction and commercial transportation. Those are very large, like $2 trillion
Hmm.
markets in construction, $500 billion in over the road commercial transportation in North America. Very large, growing at an average rate of 5% CAGR over the next several years in each case. What are we doing? Yeah, I mean, we've partnered with people, organizations like Jesse, like Phillips Connect, that are taking us into opportunities that are much bigger than anything I've ever seen. To be honest, our pipeline is robust. It's high value, high quality commercial transportation customers that we haven't been able to access before, those partnerships. On the construction side, we've always been in construction, but what's happening now because of the investments in the infrastructure on both sides of the border, we've introduced new solutions like tool tags and new partners for field service applications that are taking us into deeper and wider uh, into that market than I've ever seen before either. So, what are we doing? That's what we're doing in those markets and how we're going about it. In terms of, what I'm seeing, again, I've never seen our pipeline be this large with quality and value customers.
Hmm.
And is part of the reason why we've been successful so far this year in setting recurring revenue growth rates compared to last year or previous years.
Hmm.
It's absolutely remarkable what our investment in sales and marketing is now starting to produce. It's a
Hmm.
little bit delayed than what I had hoped for,
Hmm.
but at least it's happening. And I'm very
Hmm.
confident that I have high visibility and high confidence in our ability to close those opportunities that have been generated to date.
Hmm. Hmm. Talking about the actual devices themselves,
Mm.
what sort of features or competitive advantages do your products have?
Yeah, I think, so the devices are like if you get a tracking device from,
Hmm.
I don't know, Geotab versus AirIQ or Samsara or any of those other companies,
Hmm.
it's the same device. How you use it is where the secret is, and how
Hmm.
you bring those various solutions together. So if you have a dash camera
Hmm.
working with an ELD device with a trailer solution, how do you bring all of those together for the benefit of the customer? That's really where we're adding value and where we distinguish ourselves against other players is
Mhm.
you don't have to go anywhere else. You don't have to go to a Samsara to get this. You don't have to go to a Geotab to get that. You can
Mhm.
just come to AirIQ. Years ago, Paul, when I was on here, Small Cap Discoveries, I kind of told everybody that AirIQ was like a one-stop shop, almost like a
Mhm.
Walmart, right? That hasn't changed. And that is still our value proposition in the market when we're comparing our devices and offerings. The devices may be very similar in nature, but
Mhm.
how do you bring those together to solve problems for customers in, like I said, the fragmented IoT space is really where the value is for AirIQ.
Mhm. Mhm. Gotcha. And I kind of lied here. I've got some other questions coming in, but guys, I want you to, at some point we've got to end it. So I'm going to take Shai's questions here. Do you think the company is overinvested or underinvested in growth R&D spend? And how do you think about the required level of annual R&D spend that is needed to support organic revenue growth?
Yeah, that's a great question. I will tell you that our the leader of our development team is very pragmatic, and can handle a number of different initiatives with the team that he currently has. So he's very agile. He has this agile approach where, we're able to, you know, drop something or refocus on something else that's more important, pick up the other thing, that type of thing. So very well managed. It's one area of the business that I haven't had to think about or worry about in a long time. And it's credit to the individual running that area. Um, Going forward, I don't think there's much more we need to do in terms of R&D spend than what we've already done. So unless something out of the blue happens where, hey, it's a new new solution that requires some, additional resources, I'm not seeing that today, but I never say never. But right now, I don't see that there's a need for any more R&D spend beyond what we've already experienced.
Hmm. Gotcha. Okay, and the last part of the question here is what is the AirIQ monthly service fee for monitoring services? Is this AirIQ monthly fee typically higher or lower than industry peers?
Um, well, that's an interesting question. So AirIQ has its own proprietary platform that's been developed over, well, since its inception, almost
Mhm.
30 years ago, that has been reworked and reconfigured and that type of thing over the years. The cost of running that platform is very, very low. Um, we are engaging in other platforms, other solutions that do carry a cost with it, modest costs of anywhere from $1 to $3 a month type of thing is typical. But we always go to the AirIQ platform first as a sales strategy because it does carry with it a better margin. If we can't win the opportunity on that platform, then we move to another platform, right? That has maybe more functionality that the customer needs that AirIQ's traditional platform doesn't have. This is where those partnerships have expanded. Our device suppliers, our platform suppliers, our data carrier vendors have all expanded well beyond where our IQ was before. And that's why we're able to attract more opportunities, more pipeline opportunities, higher value pipeline opportunities that, again, the price reflects the costs associated to it. So if we have to pay $2 or $3 for a site to on a platform side, then it gets reflected in our rental plans, right, or our monthly service fees. So it depends, right? If the customer wants a lower cost, they go to AirIQ Fleet. If not, we can put them on something else, but the cost is a little bit more, but they get a better
Mhm.
experience, a better return without having to spend a lot of money on developing AirIQ to be something that it doesn't need to be to win the opportunity. So
Mhm.
hence back full circle to the question about R&D spend.
Mhm.
That's why we don't have to do anything more than what we've seen in the past, in my opinion.
Gotcha. Gotcha. Mike, you've got a handful of initiatives that you're working on right now, everything from
Mhm.
organic growth through sales and the odd bit of M&A here
Mhm.
and there. What sort of gets you excited? What gets Mike the most excited about the business right now?
Yeah, I think what gets me the most excited, and I am very excited about what I'm seeing, and finally being able to show and represent results in our most recent quarters. I'm very excited by what I see, and what I see is, you know, the Phillips Connect partnership with Jesse and so on. Phillips Connect brings everything trailer related,
Mm-hmm.
everything trailer. But there's also the cab, right? The cab
Mm-hmm.
is the dash cameras, the ELD solutions, and everything else. The drivers, the driver safety programs, all these things. That market is getting me very excited because there's so much out there and so much in our pipeline that we can take advantage of. And that, I think, in addition to continuing to do construction and all of the other markets that we're in currently, we still support and service all of those. But really, what gets me excited is this new market that is new to AirIQ. And what also gets me excited is this new down channel partnership with TD SYNNEX and working with the largest wireless carriers in the United States to get access to their sales force and their downstream customers that will open up new doors beyond what we have today. That's what is really exciting for me, that is completely new and different for AirIQ than before.
Mm-hmm. Awesome. And then, like, as investors watching the business right now, what do you think the sort of, I'd say, events or catalysts we should pay the most attention to?
Yeah, so great question, Paul. So I would ask investors to look at our capital spend on our rental pools,
Mm-hmm.
right? If you see those go up, right, like you did last quarter, I don't know,
Mm-hmm.
it was like $500,000. Well, $500,000, right, times five, $2.5 million over the life of the customer being returned at a higher value, uh, monthly recurring subscription revenue should translate into what we've been talking about: recurring revenue growth and profits.
Mm-hmm.
Follow that, and you'll see how that translates into those metrics and value creation for AirIQ's shareholders.
Fantastic. Mike, we've covered a whole bunch of stuff here. Is there anything we missed? And if not, what's the key message you want to make sure everybody walks away with today?
Yeah, no, Paul, this has been great, and thank you again. It's been a long time. I appreciate the questions and comments. I'm always available to be reached, answer any questions that anybody has following this call. I would like to leave with the Small Cap Discoveries group and yourself. Um, you know, what I've been saying and what I've been communicating throughout the presentation and in answering some of the questions, I have a high degree of confidence and visibility in the growth of our recurring revenue streams and profits, and anticipate that future quarters will reflect this. We are well positioned for better days ahead for AirIQ, its shareholders, and investors with upside investment potential. That's all I have, Paul. Thank you so much.
Well, it's plenty. No, I appreciate that, Mike. Thank you so much. We've been speaking with Mike Robb, CEO of AirIQ. Again, trades on the venture exchange under the symbol IQ. Mike, appreciate the time today and look forward to the next time we can catch up.
Yes, thank you, Paul. I appreciate everything that you're doing at Small Caps and appreciate your support. Thank you.
You got it. Thank you and bye for now.
All right. Bye for now.